First is that smart real estate investors, they don't just rely on market appreciation, 4.27% over the last 30 years. No, they force appreciation. That means that when they go to buy a property, they first start with the equity gap. They make sure that there is at least 20% between the money that they have in a house and its market value. So if it's worth $300,000, they make sure that they only have $240,000 into it. And that's their project cost, including the rehab, and their acquisition price. You see, they backwards figure what they should pay for that house in the first place. But this leads to the first of the three huge problems that these real estate investors run into, and that's project cost optimism. They don't figure in a financial contingency for their rehab costs. They think it's going to cost $50,000. Well, you need to put in at least 10%, sometimes more like 20% contingency. So $50,000, I'd put at least $55,000, maybe even $60,000. But that's not just it. Project cost doesn't just mean rehab costs. It means things like insurance. Okay, you got to have a builder's risk policy. Interest on the loan that you might get to acquire that property and do the renovation. Closing costs when you buy the property, it's going to cost you something. Utilities while you're doing the project, got to pay for power, got to pay for sewer and water. And finally, your living expenses. Okay, that's right. A lot of investors fail because they forgot to account for what it was going to cost them to live while they were doing this project. So they end up eating in to their funds for the project just to live off of. So problem number one is equity erosion because of mistaken planning, which leads me to rule number one of the solo house flipper methodology. By the way, there's 7. We're going to get to all of them today. And that is never buy without at least a 20% equity gap after all of the expenses are accounted for. And by the way, guys, if you look back at the numbers, this 20% equity gap would have solved the problem for every market crash other than 2008. Sure, you would have eaten into your profits a little bit, but that's not financial catastrophe land.